In the world of volatility, nothing is more captivating or more dangerous than a monster storm. Traders who are new to VIX ETFs often fall into the trap of thinking that massive spikes, VIX jumping to 30, 40, or even 50, happen all the time. But if we look at 14 years of institutional terminal data, the probability tells a very different story. Statistically, a spot VIX above 30 occurs less than 5% of the time. It is not the baseline of the market. It is an extreme rare structural anomaly. Think back to the most severe volatility storms in recent memory. The March 2020 pandemic crash, or the August 2024 yen carry trade unwind when VIX surged near 38, or the April 2025 tariff shock when VIX broke past 52. Every single time a monster storm hits, global funding lines freeze and liquidity vanishes into a black hole. But here's the golden rule to keep in mind. Extreme implied volatility is not only rare, it carries a violent physical gravitational pullback towards its mean. When a monster storm detonates across the market, what actually happens to the term structure? The curve flips into deep backwardation, triggering what we call the vertical strings pull on short volatility strategies. Under normal sunny or cloudy regimes, the future curve slopes gently upward in contango, where near-month contracts are cheaper than far-month contracts. But during a monster storm, aggressive panic buying floods the front end. Spot VIX and front-month futures explode upward, completely inverting the curve into deep backwardation, with basic spread reaching -20 or even the historic extremes of -39%. When this happens, inverse products like 0.5x SVXY experience sharp drawdown pressure as their low yield turns heavily negative. And because of the higher leverage coefficient, full leverage SVIX suffers a truly devastating blow. Consecutive daily jumps in one SVX will destroy all the compounding gains SVIX accumulated over the past several years, which is why, as we established in the previous episode, you must eject from SVIX the moment bad weather hits. And this nonlinear price action acts like a spring stretched to its absolute physical breaking point. The deeper the backwardation, the more potential energy the curve accumulates for an aggressive mean reversion collapse once the panic peaks. When traders see VIX exploding, their immediate instinct is to rush in and buy long volatility ETFs like UVXY or UVIX, hoping for a fast fortune. And this is what I call the long volatility mirage, because mathematically, buying long volatility products has an atrocious long-term risk-reward ratio. You are paying a guaranteed daily drag from contango decay just to bet on a low probability tail event. And I think right here lies the single most dangerous cognitive trap in option markets. The risk-reward ratio of trying to play a monster storm from the long side is astronomically bad. Even if you get lucky, even if you execute a flawless long trade, hit a historic VIX explosion, and somehow sell at the razor-thin peak before the crash, that lucky trade might actually be the worst thing that ever happens to your account. It implants a false belief. It tricks your brain into thinking you can consistently tame and capture this wild beast. And if you have watched the earlier episode in this series, you already know how that story inevitably ends. And the massive premium inside long volatility ETFs, it evaporates at hypervelocity once the storm peaks. Trying to get rich quick by chasing long volatility usually marks the beginning of an account blow up. So what is the actual institutional playbook during a monster storm? It is not buying long volatility during the panic. It is waiting for the storm to exhaust itself and then executing a post-peak rebuilding strategy using the 0.5 SVXY. And when spot VIX spikes above 30 or 40 and the curve is inverted, trying to short volatility too early is suicidal. But as soon as spot VIX begins to roll over from its absolute high and backwardation begins to narrow, the physics of mean reversion take complete control, and our institutional standard operating procedure follows two strict rules. First, never use uncapped 1H short volatility products like SVIX to fight a leaf monster storm. Always rely on the building risk cushion of 0.5 SVXY. Second, scaling using changes. Do not try to pick the exact top tick of VIX. Instead, divide your allocation into 3 or 4 changes and deploy them systematically as VIX rolls off its peak and the basic spread starts recovering. And by following this SOP, you harvest the massive volatility crash as the future curve snaps back into contango, extracting maximum alpha while keeping your tail risk fully managed. Monster storms are the ultimate test of trader psychology and market mechanics. By abandoning the illusion of chasing long volatility, respecting the physical gravity of the term structure, and executing a disciplined post-peak rebuilding plan, you turn the market panic into your greatest edge. And if you ever find yourself facing a terrifying market storm in the future, come back and review this video. Let it serve as your navigational compass through the turbulence. And thank you for watching. I will see you in the next episode.